What if I told you that 97% of all money doesn't actually exist? No coins. No paper bills. Just numbers on a computer screen. And here's the part that will blow your mind. Most of this money isn't created by governments. It's not printed in some factory. It's created by private banks. Every single day. When you take out a mortgage, a car loan, or a credit card, new money is literally typed into existence. The bank doesn't take someone else's savings and give it to you. They just add numbers to your account. Out of thin air. Sound like a scam? Sound illegal? It's not. It's exactly how the modern financial system works. And by the end of this video, you'll understand why this matters to your rent, your savings, and your entire financial future. Before we dive into how money is created, let's ask a basic question. What is money really? Money is just a technology, a social agreement, a way for millions of strangers to trade, save, and keep score. For thousands of years, humans use barter. I give you fish, you give me wheat. But barter has a problem. What if you don't want fish? What if I need something you don't have? So we invented commodity money. Gold, silver, things that everyone agreed had value. Gold worked well. It was rare, durable, and divisible. But carrying gold around was dangerous and heavy, so we invented paper money. Certificates that represented gold sitting in a vault somewhere. This worked for centuries. Then came 1971. President Nixon announced that the US dollar would no longer be backed by gold. The link was broken. From that moment on, money became something completely different. Today's money is called fiat money. It has no physical backing, no gold, no silver. It works because governments say it works, because we all agree to believe in it. And because of this change, something strange became possible. Money could now be created from nothing. So who actually creates money? Most people think it's the government. They imagine giant printing presses running day and night, spitting out dollar bills. That's not how it works. There are actually two types of money in the modern system. The first type is central bank money. This is the physical cash, the coins and paper bills. It also includes something called bank reserves, which is money that banks keep at the central bank. In the US, the Federal Reserve handles this. In Europe, it's the European Central Bank. But here's the thing, physical cash is only about 3 to 10% of all the money in the economy. So where does the other 90+% come from? That's the second type, commercial bank money. This is the money in your checking account, your savings account, the numbers you see when you log into your banking app. And this money, the vast majority of all money, is created by regular private banks. Not the government, not the central bank, your local bank, Chase, Bank of America, HSBC, Wells Fargo. They create money every single day. Now let's get to the part that changes everything. How do banks actually create money? Let me walk you through a simple example. Let's say you want to buy a house. You go to a bank and apply for a loan. Let's say $200,000. The bank checks your credit. They approve the loan. Now what happens next? Most people think the bank goes into a vault, takes out $200,000 that someone else deposited, and gives it to you. That's not what happens. Instead, the bank simply types $200,000 into your account. That's it. They don't move money from somewhere else. They create new money, brand new. Didn't exist before. In accounting terms, two things happen at the same moment. The bank creates an asset, your promise to repay the loan. And the bank creates a liability, the deposit in your account. These two entries balance each other. And just like that, $200,000 of new money exists in the economy. This is what economists call loans create deposits. It's not a metaphor. It's literally how this system works. The Bank of England confirmed this in 2014. Now you might be wondering, can banks just create infinite money? No. There are limits. Banks need to hold some reserves. They need to have enough capital to absorb losses. They need to find people who want to borrow and can pay back. And if too many loans go bad, the bank can fail. But within these limits, yes, private banks create most of the money we use every day by making loans. Now here's where things get uncomfortable. If most money is created through loans, that means most money is debt. Think about that. The dollars in your wallet, the numbers in your bank account, almost all of it exists because someone, somewhere, borrowed money. Your money is someone else's debt. And this creates a strange problem. When a bank creates $200,000 for your mortgage, they create the principal. But you owe principal plus interest. So where does the money to pay the interest come from? It has to come from money that's already circulating. From other people's income, from other people's spending. This means the system constantly needs new loans to create new money to pay the interest on old loans. It's like a treadmill that can never stop. If everyone tried to pay off all their debts at once, there wouldn't be enough money in the system. Because the money is the debt. This is why global debt keeps growing. Today, total global debt is over $300 trillion. That's governments, companies, and households combined. U.S. federal debt alone is over $34 trillion. And here's the uncomfortable truth. Debt to GDP ratios around the world are at historic highs. The system isn't designed to pay off all debt. It's designed to keep rolling it over. Forever. There's another consequence of creating money through debt. Inflation. When banks create more and more money through lending, more dollars chase the same amount of goods. Prices go up. Your salary might stay the same, but everything costs more. This is sometimes called the hidden tax. The government doesn't send you a bill, but your purchasing power quietly disappears. Let me give you a concrete example. $1 in 1925 had the same purchasing power as about $18 to $20 today. That means the dollar has lost over 90% of its value in 100 years. Your grandparents could buy a house for $10,000. Today that same house costs $400,000. And who benefits from this? People who own assets, houses, stocks, real estate. Their wealth grows with inflation. People who hold debt. Their debt becomes easier to pay back with cheaper dollars. But who loses? Savers. People who keep cash in the bank. Workers whose wages don't keep up with prices. Inflation is a wealth transfer. From savers to borrowers. From workers to asset owners. And it happens so slowly that most people don't even notice. So is there a better way? Throughout history, people have tried alternatives. The gold standard was one attempt. Money tied to a physical commodity. Limited supply. No inflation. But the gold standard had problems. It wasn't flexible enough. During crisis, countries always abandoned it. Then in 2009, something new appeared. Bitcoin. Created in the aftermath of the financial crisis, Bitcoin was designed as a reaction to everything we just discussed. No central bank. No fractional reserve banking. A fixed supply of 21 million coins. Ever. Bitcoin is an experiment in separating money from banks and governments. It has problems too. Volatility. Slow transactions. Energy use. But the fact that it exists shows that people are looking for alternatives. And governments are paying attention. Many countries are now developing CBDCs, central bank digital currencies. China has the digital yuan. The Bahamas has the sand dollar. The European Central Bank is working on a digital euro. These are government-controlled digital currencies. Some see them as the future. Others see them as surveillance tools. The monetary system is evolving. What comes next is unclear. But one thing is certain. The current system, where private banks create most money through debt, is not the only possible system. Let's bring it all together. Most money isn't printed. It's typed into existence when banks make loans. 97% of money is just numbers in bank accounts, created by private banks, not governments. Every loan creates new money. Every repayment destroys money. The system runs on debt, and it requires constant growth to keep working. Inflation slowly erodes your savings, while benefiting those who own assets and hold debt. This isn't a conspiracy. It's just how the system was designed. And once you understand it, you start to see the world differently. Why housing prices keep rising. Why wages feel stuck. Why debt never seems to go down. It all connects back to how money is created. So here's my question for you. If banks can create money by lending, should money creation be more tightly controlled? Or is this flexibility exactly what makes modern economies work? Let me know in the comments. And if you want to understand more about how the global economy really works, subscribe and hit the bell. I'll see you in the next one.